I just don't buy that. I mean, I love Bethany's work, but I think the main thing that she is missing is, well, two things. One, capital efficiency has drastically improved since you probably started that book. We're looking at these shale players now are at all-time highs in terms of capital efficiency. If you look at recycle ratio, project returns, organic growth, it's the best it's ever been. I was at a conference last week, Rystad. These guys are really the top in the business of predicting this stuff. They said break-even prices in these shale plays down 50% in about 2 years' time. So that's the first thing to iron out. And secondarily, you look at the high-quality guys in the Permian Basin. These guys all have the average net debt to EBITDA is under 2 times. So there isn't really a leverage issue there at all.
But there is a lot of debt floating around that region. I know that personally, and you know that as well.
Yeah, there's a lot of debt. But if you look at, you run the strip through our models, I mean, we see absolute compression of debt multiples going forward. I mean, you're going to see these guys now realistically drill and grow 20% production growth from within cash flow over the next few years. It's something that's actually never been done in this industry. So I could see how people are skeptical, but on our models and where these guys are now in capital efficiency, that it's possible.
One thing I like about you is you bring a lot of new names here, and I want to talk about Jagged Peak Energy, JAG, a name I'm only mildly familiar with. Who are they, and what is the quality of their land? Because now we've gotten to the point where you and I have talked about it. If you don't have the, quote, good rock, if you don't have those high-efficiency wells, that good land, you don't have a lot. Yeah,
this is a great story, and this is the reason why I'm up in Boston right now. I'm actually taking around their relatively new CEO, Jim Kleckner, to see accounts up here for the first time in Boston. And he's convincing institutional investors here that they have amongst some of the very best acreage in the Delaware Basin of their 80,000 acres, and that they've really hit their stride operationally as well. The second quarter, these guys, now Jim's been there with his team for about 2 quarters now, just absolutely crushing expectations in terms of type curves. And this is one we think investors should really take a look at.
Yeah, and then you've got Diamondback Energy, of course. That might be the original FANG stock, if you will. We've talked about that enough. Give us the lowdown on WPX. Okay, this one's a newer name, or a name that is more known, I think, to our audience. But again, what's the profile on WPX that makes it attractive to you?
Yeah, you'll like this one. So this is kind of the best of both worlds. So these guys are Bakken and Permian players. And this kind of like a hammer should have hit investors over the head 3 weeks ago. There was a big government lease sale on acreage down in the Permian, just offset WPX's position. Acreage there went up for $95,000 an acre for the winning bids. WPX is being valued by the market right now. We think the implied valuation is $35,000 per acre. So there's a massive gap there. And if industry players are willing to pay $95K an acre, you're valued at $35,000. It's kind of, hello guys, there's a pretty big opportunity here.